What happens when gold, silver, stocks, and crypto all nosedive at the exact same time? What happens when trillions of dollars in paper wealth evaporate in a matter of hours? And what happens when the systems we've been told are stable, liquid, and efficient suddenly start showing cracks that nobody in the mainstream wants to acknowledge? Well, folks, we just found out. January 30th and 31st, 2026, mark those dates, because what we witnessed in global markets wasn't just a bad day. It wasn't just volatility, it was a synchronized wipeout across nearly every major asset class on the planet, and the implications of what just happened are far bigger than most people realize. Silver futures dropped more than 15% in a single session. 15%. That's the steepest single-day slide in over a decade. Gold plunged more than 7%, one of its worst drawdowns since the early 2000s. The Dow, the S&P 500, the Nasdaq, all trending lower amid rising rate expectations and a sudden rush to the exits. Bitcoin, slipping hard as leveraged positions got liquidated across exchanges. We're talking about trillions of dollars in paper value, gone in hours. And here's the thing. While social media was lighting up with posts calling this a once-in-a-decade event, while people were drawing lines to 2008 and the pandemic crash, while the noise machine was cranking out every hot take imaginable, the real story, the structural story, was getting buried. That's what we're going to dig into today. Not just what happened, but why it happened, what it means, and what almost nobody is telling you about the mechanics underneath. If you find this kind of analysis valuable, if you want to understand what's actually going on in markets rather than just reacting to headlines, hit that subscribe button, drop a like. That's how we keep doing this. Independent, unsponsored, focused on cutting through the noise. Let's get into it. So first, let's talk about what actually triggered this cascade. Because when you see gold and silver, traditionally safe haven assets, falling in lockstep with equities and crypto, something unusual is happening. That's not normal risk-off behavior. That's not a flight to safety. That's liquidation. That's forced selling across the board. And why does forced selling happen? Leverage, margin calls, crowded positioning. See, over the past several months, we've seen an enormous buildup of speculative interest in precious metals. Gold was hitting historic highs. Silver was screaming higher. Everyone and their grandmother was suddenly a metals bull. And when everyone piles into the same trade, when positioning gets that crowded, you're essentially building a tinderbox. All it takes is one spark. That spark? Rising interest rate expectations. The market suddenly repricing the idea that central banks might keep rates higher for longer. And when that happens, leveraged positions start unwinding. Stop losses get triggered. Algorithms kick in. And this is where things get mechanical. Modern markets aren't driven by humans sitting at desks making decisions. They're driven by automated trading systems, quant models, and algorithmic liquidity strategies that react in milliseconds. When prices start falling, these systems don't pause to think. They execute. Each stop-loss triggers fire. Trend-following algorithms pile on. Risk parity adjustments cascade through the system. It's not a conspiracy. It's not manipulation in the traditional sense. It's the architecture of modern financial markets doing exactly what it's designed to do. Except when liquidity gets thin, when everyone's trying to exit at once, those algorithms don't provide cushion. They amplify. They turn a sell-off into a crash. Financial researchers call this the drift burst hypothesis, the idea that short-lived explosive moves are now an intrinsic feature of high-frequency market structure. It's baked in. It's not a bug. It's a feature. And if you're not aware of it, you're going to get caught flat-footed every single time. Now, amid all this chaos, some interesting rumors started circulating. People were talking about a major government mint pausing silver sales. Posts were flying around claiming the U.S. Mint had halted production. And I want to be very careful here, because this is exactly the kind of story that spreads like wildfire without proper context. Here's what we actually know. The U.S. Mint did temporarily suspend listings for some silver numismatic products. That's verified. They did this to reassess pricing because of rapidly escalating metal costs. Collectors noticed certain items becoming temporarily unavailable, but, and this is important, there was no formal statement from the U.S. Mint or any official government body confirming a full cessation of silver bullion minting. No strategic pause intended to influence market dynamics. And bullion coin programs like American Silver Eagles continued to be offered through authorized channels. The nuance matters. Pricing reviews and momentary sales halts are operational adjustments. They're not policy pronouncements. They're not signals of impending collapse. And when you're trying to make sense of markets, you have to separate the noise from the signal. You have to distinguish between what's actually happening and what social media wants you to believe is happening. Which brings us to one of the most misunderstood aspects of the precious metals market, the difference between paper and physical. When you buy a gold or silver futures contract, you're not buying metal. You're buying a financial instrument that derives its value from metal. It settles on an exchange, instantly, electronically. It's liquid. It's convenient. And it has almost nothing to do with the actual logistical reality of physical precious metals. Physical silver buying is a different animal entirely. Dealers have to source metal, refine it, assay it, keep inventory on hand, manage secure shipping and storage. During periods of surge demand or price stress, bottlenecks in refining and transportation can push premiums significantly above spot prices. Delivery times lengthen, dealer inventories tighten. Unlike paper contracts that settle instantly, physical transactions incur real costs and real delays. The all-in price you actually pay can be substantially higher than whatever number you're seeing on your screen. And this is where things get interesting. Because during the flash crash, we started seeing meaningful divergences between paper prices and physical market conditions. The dealers were adjusting premiums. Inventory was moving. The on-the-ground reality wasn't matching the price action on futures exchanges. Can you blame investors for being confused? The price of silver is crashing, but the guy at the coin shop is telling you premiums just went up and delivery is going to take 3 weeks. That disconnect is the market telling you something. It's telling you that paper and physical are related but not identical. They operate on different mechanics, different timelines, different constraints. And internationally, the divergences got even wider. In markets like Shanghai, physical spot prices were trading at significant premiums relative to Western exchange pricing, localized supply scarcity, delivery and logistics frictions, industrial demand pressures, all of it creating arbitrage opportunities that sophisticated traders were watching closely. The gold-to-silver ratio was swinging wildly. That ratio, the price of gold divided by the price of silver, is one of those indicators that tells you a lot about market sentiment, liquidity, and crowd behavior. When it widens, it usually means flight to safety, confidence in gold's liquidity over silver. When it narrows, speculative interest and industrial demand in silver might be driving relative performance. During this episode, the ratio was all over the place. Sharp swings in both directions. And that kind of volatility in the ratio itself tells you that underlying demand pressures are shifting rapidly, that leverage dynamics are in flux, that the market is trying to find its footing. Now, let's zoom out for a second, because I think there's a bigger picture here that's worth considering. We've been talking a lot about liquidity stress, leverage unwinds, algorithmic cascades, but there's a structural backdrop to all of this that doesn't get enough attention: the AI and data center boom. Hear me out. Over the past couple of years, we've seen an explosion in demand for large-scale data centers driven by AI, cloud computing, the insatiable need for processing power. These are capital-intensive projects, massive upfront financing requirements, long-term power commitments. They tie up credit lines and influence investor risk appetites across the board. This isn't a direct cause of precious metals flash crashes, but it's context. It's the environment in which these crashes are happening. When capital markets are already stretched, when credit is being allocated to massive infrastructure buildouts, when everyone's risk appetite is calibrated around certain expectations, any sudden repricing becomes more violent. It's like walking a tightrope. Normally you've got good balance, but when the wind picks up, when something unexpected hits, you feel it more. You wobble more, and that's the market right now, walking a tightrope in an environment where the wind is picking up. So what do you actually do with all this information? How do you navigate a market that can evaporate trillions of dollars in hours? If you're interested in physical precious metals, and I know a lot of you are, there are some basic principles worth keeping in mind. First, understand that dealer premiums over spot are part of your total cost basis. Don't just look at the spot price and assume that's what you're paying. Factor in the premium, factor in shipping, factor in storage if applicable. Second, spread your purchases over time. Dollar cost averaging isn't just for stocks. When you're buying physical metal, buying in tranches helps you avoid the mistake of going all in at a peak. Nobody can time the market perfectly, not even the algorithms. Third, decide what your purpose is. Are you holding long-term as a store of value? Are you trading opportunistically? Your strategy should match your intent, and your product selection, coins versus bars versus allocated bullion, should match your liquidity needs. Fourth, pay attention to delivery reliability and inventory backlogs, especially during volatility spikes. If a dealer is quoting you 3-week delivery on something that usually ships in days, that's information. That's the market telling you something about real conditions on the ground. And finally, and this is maybe the most important point, prioritize verified market data over social media hype. I know it's tempting to get caught up in the noise. When silver drops 15% in a day, your timeline is going to be full of hot takes. Some of them will be insightful. A lot of them won't be. What actually matters? Registered vault stocks available for delivery, dealer premiums, physical delivery lead times, exchange inventory reports. These are objective measures that give you a grounded view of real market conditions. Wild comparisons to 2008 or the pandemic crash can be rhetorically powerful, but they're not predictive. Current trading patterns are shaped by different structural dynamics: algorithmic liquidity provision, high leverage in futures and ETFs, central bank policy expectations. The mechanical drivers are different. The context is different. Does that mean everything's fine? No. Does that mean you shouldn't pay attention? Absolutely not. But it does mean you should be careful about taking viral commentary as gospel. Separate noise from signal. Track the data. Think structurally. Look, what happened on January 30th and 31st was significant. Trillions of dollars in paper value, gone in hours. A synchronized crash across asset classes that are supposed to be diversified. A glimpse into the mechanical fragility of modern market structure. But it's not the end of the world. It's not 2008. It's not the apocalypse. It's a reminder. A reminder that leverage cuts both ways, that algorithms amplify moves in both directions, that the paper market and the physical market are related but not identical, and that in an environment where capital is stretched, where structural stresses are building, where the tightrope is getting narrower, you need to be paying attention. So pay attention, track the data, think critically, and if you found this valuable, hit that like button, subscribe if you haven't already, share this with someone who needs to hear it, because we're going to keep doing this. We're going to keep cutting through the noise. We're going to keep following the money, the mechanics, the things that actually matter. I'll see you in the next one.